Yeah, CSL obviously on a tear here, $1.42. It's all-time high here, really on the back of its really first foray into a local blood plasma fractionation market in China, taking out an 80% stake in a local fractionator, Wuhang Hongyong Rude Biologics. Yeah, it's a mouthful, but it's just Rude for short. $352 million it spent for that acquisition. The remaining 20% stake is linked to milestones, so there are really call options on that, equating to 96 to 142 million if that gets across the line, the other 20%. So what does Rude really give CSL? Well, it really gives them access to the local market. Now in China, the market's about $3.5 billion, 3.3 actually, dollars, growing at a double-digit rate. That's above what the U.S. market will do, but it's 7 times smaller than the U.S. market, but growing in a faster clip, as I just said. Rude does offer a portfolio of plasma-based products for CSL. It does have 1 manufacturing facility as well as 4 collection centers to collect its raw material. This actually will complement CSL's current stand in China. It currently has 16% market share, and it gets that by selling 1 product into that China market called albumin, one of their main products. It does about $500 million in sales, and it's growing at double-digit rates. It represents about 7% of the global top line for CSL. So it's a nice complement to that product. But will it really move the needle in the near and medium term? Likely not. Rude has sales of $30 million. That represents less than 1% of the China market currently. But CSL believes through its optimization of this infrastructure and pushing through more capacity in its plants and extending the collection centers, that it can grow that $30 million into $100 million in a 5-year period. Now, back of the envelope, you can look at the CAGR there. It's about 27%. For me, that's quite aspirational when this market is growing in the mid-teens rate. But looking at the net bottom line here, they're saying that they can grow that business in 5 years, as I said, to about $35 million in MPAT or EBIT, which really represents 1% of its total out-year earnings. So a very, very small component. And really looking at the return metrics here on this, and I think a lot of people haven't done this, you really got to scratch your head and think, well, you really have to believe in this long-term China story to really play out if this thing's going to make sense. So all in, we estimate the company, CSL, we're going to spend about $500 million for this acquisition. That's 100% if they do take up that 20% remaining stake, which I believe they will do. Represents a sale multiple about 16 times is what they're going to pay for this little acquisition. Yes, it is China. Yes, it's big. Yes, it's growing, but that's pretty expensive. And that's on its own 5-year estimates, and that's with optimization of their plant in China. That's with getting more collection centers online in China. They're looking to grow this business, but it's really looking at the 5-year estimates. Optimization I think are equating to an ROI of around 6%. Now, I tell you, the cost of capital for CSL is 8%, so you can work out the numbers on yourself. It's definitely below the cost of capital there on a 5-year outlook. So not that we're all cynical, but seriously, I really struggle to find one pharmaceutical company, let alone one company, a foreign company that's gone into China and really shut out the lights. So you really have to believe that this is a long-term strategic play, really, to us, a really expensive toe in the water, I would say. But you know what? If CSL can't do it, no one can. They're a great quality company, a great, fantastic operator, but they just paid up a lot for this acquisition. So long-term, as I said, strategic play. What do you do with the stock here? Continue to like CSL as a core portfolio holding. We haven't deviated. That hasn't changed in our thesis at all. But it actually surpassed our price target of $1.33. So looking here, I'm still saying I would trim into any strength in this company right now, especially if you have overweight positions in your portfolios. So that's kind of the key takeaway there.